welcome the Chair of the Financial Stability Oversight Council, Secretary Janet Yellen.
And good morning, everyone. I'd like to call this meeting of the Council to order and thank you, everyone, for joining today's meeting. We have 4 items on the agenda today. First, we'll hear a presentation and then take a vote on the Council's 2021 annual report. We'll next vote on the charter for the Council's climate-related Financial Risk Committee. Then we'll hear an update on the transition from LIBOR. And finally, we'll vote on the minutes of our last meeting. With that, let's turn to our first agenda item. Today, the Council is releasing its 2021 annual report. The report has one eye on the past and one on the future. It analyzes recent episodes of financial turmoil to understand weak points in our financial system, and it identifies potential threats. It reviews actions taken by the Council to strengthen our financial system and recommends additional steps that could be taken by the public and private sectors. The report marks nearly 2 years since the first appearance of COVID-19 and the resulting financial turmoil in March 2020. As the economy began to shut down that month, many investors sought safety in the form of cash and short-term government securities. Corporate and municipal bond markets became illiquid. Of course, increased capital and liquidity helped banks weather the crisis. And in that way, the episode showed that our financial system is far more shock resistant than it was in 2008. As this report shows, the lessons of 2008 and 2020 strongly inform the Council's work. I'm pleased to have the opportunity to summarize the work of the Council. In particular, I'd like to take a moment to review 3 key priorities for the Council that I outlined 9 months ago in my first meeting as chair. The first priority was non-bank financial intermediation, including money market funds, open-end mutual funds, and hedge funds. In March 2020, we saw that open-end mutual funds and prime money market funds could amplify liquidation pressures because of liquidity risk in their business models and the incentives they give to investors. And the same held true for hedge funds because of their use of leverage. Our report reviews the Council's progress on work related to these 3 sectors. In June, the Council issued a statement regarding the structural vulnerabilities of money market funds. It called for reforms that would improve the resilience and functioning of short-term funding markets. The Council expressed support for the SEC's engagement on this critical issue. And I was pleased to note the SEC's proposed rule earlier this week. The Council will continue to monitor this effort. And in addition, the Council's working groups on open-end funds and on hedge funds are assessing the risks posed by these types of funds and will evaluate whether actions are necessary to address their vulnerabilities. A second priority was the resilience of the U.S. Treasury market. The Treasury market is the deepest and most liquid market in the world. Because of its critical importance to the financial system, we must understand the disruptions that have occurred in that market. The Council's annual report reviews the progress of the Interagency Working Group on Treasury Market Surveillance, which has worked closely with the Council to study what happened in March 2020 and what it had in common with other recent episodes. The Interagency Working Group is analyzing ways to improve the Treasury market's resilience. They're looking at possible policies to improve data quality and availability, to bolster the resilience of market intermediation, evaluate expanded central clearing, and enhance trading venue transparency and oversight. The annual report also discusses the Council's new body of work around climate-related financial risks, which is the third priority I spoke of in March. I'm very pleased at the Council's progress in the short period since then. As I've previously said, even as the Council and regulators make progress in ensuring that the past doesn't repeat itself, we must keep in mind the maxim that we cannot simply fight the last war. The Council is required to evaluate and respond to new and emerging threats. With this purpose in mind, the Council issued a report on climate-related financial risk in October that made recommendations to promote the resilience of the financial system. These steps include expanding capacity, improving data and measurement, enhancing disclosure of climate-related risk, assessing the scale of potential vulnerabilities, and adjusting regulatory and supervisory tools. To help coordinate our efforts on these issues, the report called for the Council to establish a new staff committee, the Climate-Related Financial Risk Committee, and later in today's meeting, the Council will vote to do so. Of course, climate is not the only emerging risk. As the annual report details, risks to U.S. financial stability are elevated compared to before the pandemic, even as the financial vulnerabilities of banks and central counterparties are low. For instance, the report discusses potential shocks related to the elevated level of uncertainty characterizing the global growth outlook. The report also discusses vulnerabilities related to elevated asset prices, for example. In addition, the report highlights the critical importance of regulatory attention and coordination regarding stablecoins and other crypto assets, as the market for these assets continues to rapidly grow and evolve. And cybersecurity remains a high priority, as does LIBOR transition. I look forward to engaging with the Council in 2022 on these issues and others discussed in the report. Now let me turn it over to Sandra Lee, the Deputy Assistant Secretary for the Council at Treasury, who will provide an overview of the report's findings and recommendations. And Jonathan Rose from the Federal Reserve Bank of Chicago and Alexandra Summers from Treasury are also available for questions. Sandra.
Thank you, Madam Secretary. I'm pleased to present the Council's 2021 annual report. This year's report is once again the product of extensive collaboration among all of the Council members and member agencies. In addition, the report brings together a number of interagency work streams, including on climate-related financial risk, Treasury market resilience, non-bank financial institutions, and stablecoins. Each of these work streams itself represents similarly extensive collaboration. I would like to acknowledge this hard work and express my gratitude to everyone that made this work possible. In the annual report, the Council reports to Congress each year on certain subjects: the activities of the Council, significant financial market and regulatory developments, and potential emerging threats to U.S. financial stability. In addition, in the annual report, the Council makes recommendations to enhance U.S. financial markets, promote market discipline, and maintain investor confidence. This year's report comes a year and a half after the onset of the COVID-19 pandemic. As the report describes, the United States economy has continued to rebound from disruptions related to the pandemic. This recovery has been supported by monetary and fiscal policy, substantial progress in vaccination, and broadly accommodative financing conditions. The report also analyzes certain key economic developments that have accompanied this recovery, including the growth of asset valuation pressures in residential housing and in other markets, supply chain challenges, and tightness in labor markets. In my remarks, I would like to highlight some of the potential emerging threats and related recommendations in this year's report. The first topic is climate change. The 2021 annual report is the first to identify climate change as an emerging threat to the financial stability of the United States. It details the Council's work leading up to the publication of the Council's report on climate-related financial risk in October. The annual report notes the critical importance of taking prompt action to improve the availability of data and measurement tools, enhance assessments of climate-related financial risks and vulnerabilities, and incorporate climate-related risks into risk management practices and supervisory expectations for regulated entities where appropriate. In addition, the report also recommends that financial regulators, consistent with their mandates and authorities, should promote consistent, comparable, and decision-useful disclosures that allow investors and financial institutions to take climate-related financial risks into account in their investment and lending decisions. A second topic in the annual report is a transition from LIBOR. After years of planning and preparation, the transition away from LIBOR is entering a critical stage. The report discusses a few risks related to this transition: the selection of new reference rates, the possibility of continued issuance of instruments that create or extend LIBOR exposure, and legacy contracts without robust fallback provisions in the event of LIBOR cessation. The report emphasizes that market participants should act with urgency to address their existing LIBOR exposures and transition to robust and sustainable alternative rates. A third topic is digital assets. The report details several risks related to digital assets, including high price volatility due to speculative activity, the possibility of operational failures, fraud, and market manipulation, risks stemming from direct or indirect connections with banking services, financial markets, and financial intermediaries, illicit financing, national security, cybersecurity, privacy, and international monetary and payment system integrity. The report analyzes stablecoins in detail, summarizing the report on stablecoins published in November by the President's Working Group, the FDIC, and the OCC. The report recommends that federal and state regulators continue to examine risks to the financial system posed by new and emerging uses of digital assets and coordinate to address potential risks that arise from those digital assets. Regarding stablecoins, the report notes that the Council will further assess and monitor the potential risks of stablecoins and recommends that its members consider appropriate actions within each member's jurisdiction to address those risks, while continuing to coordinate and collaborate on issues of common concern. The report notes that the Council will also be prepared to consider steps available to it to address risks outlined in the PWG report in the event comprehensive legislation is not enacted. The fourth issue I'd like to highlight is cybersecurity risk. The annual report notes that the financial sector, like other critical sectors, is vulnerable to a cybersecurity incident. The report also notes that the implementation of teleworking strategies can increase cybersecurity vulnerability. The report includes a number of recommendations, including that federal and state agencies continue to monitor cybersecurity risks and conduct cybersecurity examinations of financial institutions and financial infrastructure to ensure, among other things, robust and comprehensive cybersecurity monitoring, especially in light of new risks posed by the pandemic, ransomware incidents, and supply chain attacks. The fifth and final issue I'd like to highlight is the global growth outlook. The report notes that this outlook is characterized by elevated uncertainty, with the potential for continued volatility and unevenness of growth across countries and sectors. Risks include the possibility of higher than expected inflation, the possibility that financial vulnerabilities in China could lead to a hard landing, and the possibility that the ongoing pandemic could continue to cause volatility in economic activity. The report recommends that member agencies ensure that the financial institutions they oversee are attentive to the risks posed by uneven or volatile global growth. In conclusion, the annual report provides an overview of the Council's identification of potential risks or vulnerabilities on these 5 subjects, as well as other several important areas. The report highlights key actions taken and makes additional recommendations for addressing these risks. Thank you.
Thank you very much, Sarah. Before we vote, I know that some of our council members would like to say a few words about the report, and let me ask Chair Powell to start us off.
Thank you, Madam Secretary. So we meet today again to vote on the approval of the annual report. Each year, we come together to identify emerging threats to financial stability and make recommendations for how to address them. And this year's report, again, represents an impressive effort, and we're happy to support it. It builds on an already comprehensive review of risks by including progress in the 3 priority areas noted by the Secretary. In each area, the annual report documents progress made in assessing the issue and identifying steps that the FSOC and its member agencies can take to reduce systemic risks going forward. It's been another year of unique challenges, but also of notable productivity and focus. The annual report, as always, is a testament to the cooperation and coordination among the organizations represented here today, and to the standard of excellence that each of us maintains in pursuing the FSOC's mission. So I want to commend and thank the staff who worked to make this important report a reality. Thank you.
Thank you, Jay. Chairman McWilliams.
Thank you so much, Madam Secretary. I'm struggling with the buttons here. Give me a second. I just want to make sure you can hear me. You can hear me okay?
Yes.
All right, wonderful. I would also like to thank the staff for the significant effort that went into this production of this annual report. It's always a big endeavor. A lot of people are involved, and the work product is always superb. So I'm grateful to staff. I will say that following significant economic turmoil in 2020, the banking system remains resilient to the ability of all of us to take a deep breath and be grateful for that. In sharp contrast to the financial crisis of 2008, only 3 banks have failed since the start of the pandemic in March of 2020, and none due to the pandemic or the ensuing economic stress. At the same time, banks across the country have accommodated an extraordinary growth in deposits, as we have seen from our most recent call report data and quarterly banking profile. In 2021, the banking sector remained a source of strength for the economy, again, to the relief of all of us, reinforced by banks' strong capital positions. Banks remain strongly capitalized in the third quarter of 2021, holding a higher amount and quality of capital than just prior to the 2008-2013 banking crisis. These are signs to be cautiously optimistic, but the FDIC will nonetheless carefully continue to monitor economic trends, deposit trends, and other factors that affect the health of the banking sector. In particular, the FDIC remains vigilant about the potential effects of inflation on banks and their customers, the potential economic impact of Omicron, and the evolution of certain markets post-pandemic, including commercial real estate. Thank you again, Madam Secretary, and thank you to the FSOC staff for your hard work to prepare this report in a productive collaboration in its preparation. We are very grateful for your work. Thank you.
Thank you very much. Chair Gensler.
Thank you so much, Madam Secretary. I've too, like my colleagues, want to thank the staff and the cooperation and collaboration across the agencies. I think the points that were identified, I support in the report. I would say I've asked staff at the SEC to address a number of the points raised in the report and make recommendations to our commission for proposals and notice and comment to the public on a handful of resiliency projects. You've seen one of those this week in the money market fund. I think both money market funds and open-end bond funds, we learned new things last year in 2020. They're highlighted in this report, and then we're going to try to do our part at the SEC based on good economic analysis and hearing from the public, but working with everybody also in treasury market resiliency, the stock market resiliency, and some of the projects we have to shorten settlement cycles. And importantly, what we're working on across our various agencies in crypto assets. This $2.5 trillion asset class may not be the largest of the asset classes, but it's unfortunately largely operating right now outside of the banking and market regulator remits. And while we each have some jurisdiction and authorities, and we each think our authorities may be clear, there's a lot out there that I think could be growing instability in the crypto markets. And lastly, just because it's in this report and a later comment here, we're working on climate risk disclosures as identified for consistent, comparable, and decision useful, as I think Sandra said earlier. And on LIBOR transition, I think that's really important, and I'll continue to sort of use whatever tools we have at the SEC. But I do worry that some parts of the market want to rely on rates, a replacement rate for LIBOR that's still sort of put upon a market that will collapse in the middle of a stress. And I spoke about this at our earlier meeting several months ago, but I think the so-called BSBY rate has infirmities and will not stand the test of time, will not be good for financial stability for later FSOC members. Thank you.
Thank you, Gary. Chairman Benham.
Thank you, Secretary Yellen. I'm also happy to support the annual report, and echoing my colleagues' comments, would most importantly like to commend the FSOC and the staff for putting an excellent report together. From a CFTC perspective, the report does note the $600 trillion US derivatives market has experienced and continues to experience substantial volatility and at times turbulence driven by a multitude of factors, some of which have been already identified, but weather impacts, supply side constraints, and fluctuating demand levels in the past few years have certainly moved markets in ways that we have not seen before. The CFTC has been on high alert to ensure the fairness and resilience and the effectiveness of these derivatives markets. For context for the public, our markets cover commodities, financial or index products that serve price formation, price discovery, and risk management for everyone from farmers and ranchers in our economy to drillers, producers, and manufacturers. The overall risk levels remain elevated and continue to receive heightened monitoring and attention by the agency. Also, I'd like to commend the FSOC on its decision to include and examine the LIBOR transition, as was recently discussed by Chair Gensler, climate-related financial risks, and stablecoins as well. All issues that continue to be a significant focus here at the CFTC. Thank you very much.
Thank you. Director Chopra.
Thank you so much, Madam Secretary. And the release of the 2021 annual report provides a useful opportunity to look ahead and chart our priorities for 2022. And we are pleased to support it and want to acknowledge all of the efforts that went into it. CFPB and other FSOC members are grappling with the significant consumer protection implications of the entry of the globe's dominant technology platforms into financial services. Because companies like Facebook, Amazon, and Google understand that surveillance of transaction activity can be used to monetize their broader business model. It not only raises concerns about consumers and data, but also broader questions about the separation of banking and commerce. Given their massive user bases, inherent network effects, and access to troves of data, these firms could scale their own financial services activities rapidly, potentially posing underappreciated risks to financial stability. These incumbents could become dominant financial services providers almost overnight, and it's important for the FSOC agencies to assess the implications of this. My immediate concern is the financial system's increased reliance on 3 cloud services providers: Amazon Web Services, Microsoft Azure, and Google Cloud. We know operational disruptions at these providers can paralyze communications and web platforms. If operational issues were to impact the core services banks and other institutions provide, it could undermine confidence in the financial system. Of course, the risks posed by concentration in cloud services have implications for nearly every sector of the economy. And as the report notes, the FSOC supports the efforts of the Financial and Banking Information Infrastructure Committee to pursue work on this topic. At the same time, it is worthwhile for us to evaluate risks specific to financial markets and financial stability to determine whether any of the FSOC's tools should be brought to bear to mitigate them. Thank you, Madam Secretary.
Thank you. Acting Director Thompson.
Thank you, Madam Secretary. First, I want to thank each agency staff for their hard work, including climate-related financial risk as an emerging threat to U.S. financial stability is important to implementing the FSOC climate report recommendations. FHFA is committed to improving public awareness of climate risks, especially those that are related to the housing sector, and we will work collaboratively with other FSOC member agencies. I also want to thank the Council for recognizing FHFA and our regulated entities' efforts to provide relief to borrowers and renters that were affected by the pandemic, as well as our efforts to expand affordable and sustainable housing. Housing affordability in a sustainable manner remains a key priority for FHFA. And finally, I want to thank the Council for once again recommending that FHFA and the NCUA be granted examination and enforcement authority over third-party service providers. There's a continued discrepancy in authority among financial regulators in this area that needs to be addressed. Examination and enforcement authority over third-party service providers is an important tool to help FHFA ensure the safety and soundness of our regulated entities, and I'm grateful for FSOC's continued support on this issue.
Thank you. Acting Controller Sue.
Thank you, Madam Secretary. I'm just going to echo what everyone else has said and say, really thank the staff for some excellent work on this report. And I'm looking forward to working with everyone on these issues next year. Thank you.
Thank you. Chairman Harper.
Thank you so much, Madam Secretary. I too will support this report and want to thank staff for issuing a comprehensive document. I also, like Sandra, greatly appreciate that this report once again recommends to Congress that the NCUA have examination and enforcement authority over third-party vendors. It's especially needed right now. In October, the NCUA board, without my support, adopted a rule to expand the lending activities permitted by credit union service organizations. While I voted against this rule, it is now on the books, and I do have concerns that we will now have new risks to the credit union system. This is a regulatory blind spot that is now widened, and we really need to work to close it. Examination and enforcement authority over external vendors has always been important, but even now more so. Thank you.
Thank you. Independent Member Workman.
Thank you, Madam Secretary. I want to express my appreciation to all of you, to your staffs, and for the skill and hard work that went into producing this year's excellent annual report. I especially commend the expertise and cooperation that I and my staff have seen demonstrated by the Federal Insurance Office and the NAIC. Finally, I want to specifically note and reiterate my continuing support for the annual report recommendation regarding pensions data and the importance of that recommendation. I wish each of you a joyous holiday season, and I look forward to working with you all during the coming year. Thank you.
Thank you. Director Felischetti.
Thank you, Secretary Yellen. I want to add my congratulations to others expressed here today for a job well done on the FSOC annual report. As always, this report reflects great collaboration among the FSOC Secretariat, staff, and all members and member agencies. We, we were even able to lend OFR staff to support this effort. Since my confirmation, I have prioritized the OFR's efforts in fulfilling our Dodd-Frank mandate, that is principally support FSOC and its members. By continuing to do so, our office is well equipped to support FSOC's current priorities. Indeed, OFR is already underway on several of these efforts as outlined in the report, including climate, short-term wholesale funding, and central counterparties. In the meantime, we will continue to monitor, analyze, and share what we see with our FSOC colleagues. And with that, I yield back.
Thank you. Director Seitz.
Thank you, Madam Secretary. I'll also briefly thank the FSOC team, particularly Sandra and Jonathan, for all of the work in putting together today's FSOC annual report. Also, thanks to the staff at the various agencies for all of their efforts, and also for the coordination and collaboration across the members on this year's report. Thank you, Madam Secretary.
Thank you. And Commissioner Lubin.
Thank you, Madam Chairman. I would like to join my colleagues on the council to express our appreciation for the outstanding work of the staff and council member on this year's reports. The pandemic has presented novel issues in retail markets, consumer finance, and asset valuation. The work of this council and its members significantly helps to protect investors and maintain orderly and efficient markets. We look forward to continuing to work collaboratively on the issues highlighted in this report, including climate change, digital assets, and cybersecurity concerns. Thank you very much.
Thank you very much. Is there anybody else who would like to comment? Okay, then is there a motion to approve the resolution approving the council's 2021 annual report?
So moved.
Second?
Second.
Second.
All in favor?
Aye.
Anyone opposed? Okay, thank you. Any abstentions? Okay, the resolution is approved. Thank you. Thank you, everybody. And now let's turn to our next agenda item, which is the establishment of the Climate-Related Financial Risk Committee. And Sandra Lee from Treasury will provide us with an overview of the proposed committee.
Thank you, Madam Secretary. The FSOC's report on climate-related financial risk, which the Council published in October, announced that the Council would establish a Climate-Related Financial Risk Committee, or CFRC, within 60 days. Today, the Council will vote on creating this new staff-level committee. The proposed committee charter will establish the CFRC and formalize its purposes, duties, and operating structure. The CFRC will play a central role in interagency collaboration to identify, assess, and mitigate climate-related risks to the financial system. Through this committee, staff from across the Council members and member agencies will meet and share information as they work to implement the recommendations in the FSOC's climate report. The proposed structure of the CFRC is similar to the charters of the other 5 FSOC staff-level committees the Council adopted in 2015. Based on our experience with those existing committees, we expect the CFRC to leverage each Council member agency's unique expertise and to promote shared responsibility among the member agencies. The committee charter the Council is voting on today sets forth the duties of the CFRC based on the needs identified in the FSOC's climate report. These duties include identifying priority areas for assessing and mitigating climate-related risks to to the financial system, facilitating information sharing and coordination among staff of council members and member agencies relating to climate-related risks to the financial system, coordinating efforts among council members and member agencies to address data gaps and to develop data standards regarding climate-related risks to the financial system, and providing updates to the council at least semi-annually on the status of efforts by staff of council members and member agencies, to identify and address climate-related financial risks. The CFRC will also be responsible for overseeing the council's climate-related financial risk advisory committee, which we are currently working to establish. This advisory committee will provide the council with input on climate-related financial risks from a broad array of stakeholders. We will update the council at a future meeting on the development of the advisory committee. Staff recommend that the council vote to establish the CFRC and to adopt the proposed charter, which would then be posted on the council's website. I'd be happy to answer any questions you may have. Thank you.
Thank you, Sandra. When the council issued the report on climate-related financial risk in October, I said the report was a first step, not our final word. And today we're taking another step forward. The Climate-Related Financial Risk Committee will help us collaborate on the recommendations we agreed to in the FSOC report. Addressing climate-related financial risks is an urgent priority, and it will require our collective efforts. Before we vote, I understand some of you would like to say a few words. Let me turn first to Acting Controller Sue.
Thank you, Madam Secretary. I fully support the FSOC's vote today to create the Climate-Related Financial Risk Committee. The CFRC will play an important role in identifying priority areas for assessing and mitigating climate-related risks to the financial system, coordinating information sharing, aiding in the development of common approaches and standards, and facilitating communications across FSOC members and interested parties. Addressing climate-related risks to the financial system requires the collaboration of multiple parties and partnerships using many strategies and mechanisms. Consistent with our safety and soundness mandate and the recommendations of the FSOC report on climate-related financial risk, the OCC yesterday issued for public feedback draft principles for climate-related financial risk management for large banks. We are hopeful that the principles will promote and accelerate improvements in banks' climate risk management practices. I look forward to working with the CFRC and our interagency peers on this critical topic. Thank you.
Thank you. Chair Powell.
Thank you, Madam Secretary, and thank Acting Comptroller Sue for those remarks as well. We look forward to reviewing comments on the principles the OCC released yesterday, and as we continue to move toward the development of an interagency set of supervisory expectations for the management of climate-related financial risk with a focus on large banks. A consistent approach across bank regulatory agencies will best support the effective management of these risks. And more broadly, the FSOC's Climate-Related Financial Risk Committee will help all the financial regulatory agencies share information and findings on climate-related financial risk. The Fed is committed to ensuring that these supervised firms have strong risk management capabilities to promote their resilience to all risks, including climate-related financial risks. Again, thank you.
Thank you. And is there anyone else who would like to comment before we vote? Okay, then let's turn to the vote. Is there a motion to approve the resolution approving the charter for the Climate-Related Financial Risk Committee?
So moved.
Is there a second?
Second.
Second.
All in favor?
Aye.
Aye.
Any opposed? Any abstentions? Okay, the resolution is approved. Thanks. And next, we have an update from the staff of the Federal Reserve Board on the transition from LIBOR. I'm going to turn it over to Michael Gibson, Director of the Division of Supervision and Regulation at the board, for a presentation.
Thank you, Secretary Yellen and members of the FSOC. for the opportunity to provide an update on the momentum we are seeing in the transition away from LIBOR. As a result of all the work on the transition, a nearly decade-long effort bringing together market participants and regulators from around the world, US and global financial markets are now stronger and more resilient. Trillions of dollars in financial contracts now rest upon reference rates that are transparent, well-designed, well-managed, and grounded in market transactions. Thanks to the work of the Alternative Reference Rates Committee, or the ARC, which is the private sector group leading the transition in the United States, the key risks presented by LIBOR, that it was based on fragile and thinly traded markets, that it was subject to manipulation, that it relied often on judgment rather than market transactions, those are now largely behind us. The ARC recommended the Secured Overnight Financing Rate, or SOFR, as its preferred rate because SOFR is transparent and resilient, resting on one of the deepest and most liquid markets in the world. Along with our fellow supervisors, we have told banks that entering new LIBOR contracts after December 31st would create safety and soundness risks, and we will supervise firms accordingly. With just 2 weeks to go, the progress we have seen in markets is encouraging. Open interest in linear swaps referencing SOFR has increased sevenfold, from just under $1 trillion in September of 2020 to over $7 trillion last month. Cross-currency swaps between the US dollar and other major currencies have almost completely transitioned to SOFR and other risk-free reference rates. 90% of recent floating rate note issuance has been linked to SOFR, and all newly issued floating rate agency mortgage-backed securities are now based on SOFR. While the loan market had initially been slow to transition to alternative rates, firms are now reporting that a majority of new business loans in the fourth quarter have been utilizing alternative rates, primarily SOFR. Over the next year, we will be looking for a real decline in outstanding LIBOR exposures as firms stop entering into new LIBOR contracts and existing LIBOR contracts mature. Though our supervisory guidance directly impacts banking organizations, other market participants should also prepare for the end of LIBOR. Liquidity in US dollar LIBOR instruments is likely to fall during 2022. So all market participants would be wise to transition soon to alternative reference rates. Let me turn now to transition planning for existing or so-called legacy LIBOR contracts. There are currently more than $200 trillion of legacy LIBOR contracts. To assist with the transition of these contracts, US dollar LIBOR will be available in most tenors through June 2023. The ARC estimates that this will allow about 2/3 of legacy contracts to mature according to their original terms. Nevertheless, some legacy LIBOR contracts will mature after June 2023. Many of these contracts will fall back to alternative reference rates, but some do not include workable fallback language. While a couple states have enacted legislation to allow the tough legacy contracts governed by these states' law to transition to SOFR-based rates, federal legislation would establish a clear and uniform solution on a nationwide basis. I'll conclude, the transition away from LIBOR is advanced and accelerating, and our financial system will be more stable as a result. Thank you.
Thank you very much, Michael. Since the council last discussed this important topic, the market has made a great deal of progress in the transition away from LIBOR. The share of new issuance in secondary market activity tied to LIBOR continues to decline, and the pace of transition to more durable rates like the Secured Overnight Financing Rate has accelerated in the past few months. The CFTC-sponsored SOFR First initiative has been helpful in driving the transition in interdealer markets, and the Alternative Reference Rate Committee's formal recommendation of a term SOFR rate has given derivatives markets the tools to increase SOFR liquidity, particularly for business loans. But despite this progress, more work remains to be done. With only 2 weeks remaining before two crucial year-end LIBOR deadlines, it's important that market participants continue to prepare for the cessation of several LIBOR currency tenor pairs, as well as ensure that they're ready to meet supervisors' expectations regarding new LIBOR exposures. More progress is also needed on the transition to more durable exchange-traded derivatives. Additionally, I've encouraged Congress to adopt legislation that will facilitate a smooth transition and eliminate potential uncertainty. Let me stop there. I understand that several other members would also like to make statements. Chair Powell, would you like to offer some comments?
Just briefly, Madam Secretary, you really covered the points. That we are seeing real progress moving away from LIBOR, which we need to see at this point because, of course, supervisory guidance says no new LIBOR after December 31st. This is a very complex and ongoing transition that's been going on for more than a decade, actually. But we're making progress. And I would just the last thing I would say is there's a need to persist, and we look forward to getting supporting legislation to underpin the smooth changeover. And that's really, I'll leave it there. Thanks.
Thank you. Acting Controller Sue.
Thank you, Madam Secretary. I just want to echo what Mike and Chair Powell and you have kind of mentioned with regards to LIBOR. The only thing I would want to add is I really want to thank the staff and the ARC for their extraordinary work on this. The ARC and its many members, working through multiple subcommittees and work streams, have been wrestling with a host of extremely complex challenges at no small expense to themselves for many years. The American people will never know just what a Herculean effort this has been, but on their behalf, I want to take this opportunity to compliment everyone involved and to thank them for their service. Thank you.
Thank you. Chairman McWilliams.
Thank you, Madam Secretary. The FDIC remains actively focused on the LIBOR transition. Our institutions continue to move in the right direction to address the LIBOR transition and adopt a replacement rate by December 31st. Banks are also dealing with the challenges of legacy contracts and making adequate preparations for LIBOR's discontinuation. We have not noted significant outliers among FDIC-supervised institutions, which is always a good sign. We have found that many of our institutions, particularly smaller community banks, do not have material LIBOR exposures. Institutions that do generally have made concerted efforts to transition away from LIBOR and are on track to issue new contracts in another reference rate by year end. For several years, the FDIC has conducted industry outreach on the LIBOR transition to encourage the identification of exposures, timely implementation of a replacement rate, and amendments to legacy contracts as appropriate. In addition, the FDIC participated in the issuances of several interagency statements emphasizing supervisory expectation, including as recently as this past October. We will continue to monitor the LIBOR transition during safety and soundness examinations in 2022 to ensure that a replacement rate has been implemented for new contracts and legacy contracts are being appropriately addressed. But overall, it's a positive sign from FDIC supervised institutions, and we're very pleased with the developments. Thank you.
Thank you. Chairman Benham.
Secretary Yellen, you covered a lot of the points I was going to make, as well as Mike, about the SOFR First initiative that we started here at the CFTC under the sort of auspices of a subcommittee, working closely with the ARC and the New York Fed all along. You mentioned we've completed 3 phases which have had a profound effect on linear, nonlinear, and cross-currency swaps just in the past 6 months. You also mentioned the most critical step is the exchange-traded derivatives, which is essentially the euro-dollar contract, which moves based on LIBOR. And the one thing that I do want to sort of share with the public, we included essentially a guide for this final phase. And the main message or messages of the guide are: all market participants are encouraged to ensure operational capability to transact in SOFR exchange-traded derivatives as soon as possible. All market participants are encouraged to adopt the best practice of replacing use of LIBOR with SOFR in new contracts, including exchange-traded derivatives, after year-end 2021. And in summary, all market participants should be transitioning away from LIBOR now, bank and non-bank market participants alike. as you pointed out, this is going to be it is the last step, but it's the biggest step with the exchange traded contracts. But certainly with its success should move us very close to an overall very successful transition in the past decade. So thank you.
Thank you. And Chairman Harper.
Thank you, Madam Secretary. Through the Federal Financial Institutions Examination Council, we have maintained clear, coordinated, and consistent messaging to our respective regulated entities. This coordination is an example of government working the way that it should. Going forward, we need to continue to ensure that our regulated entities make use of new and appropriate reference rates that are both transparent and reliable. We want to ensure also that new contracts have robust fallback language. We still have much work ahead, but I'm confident that our positive momentum will continue us moving us forward.
Thank you very much. Is there anyone else who would like to make a comment, Gary?
I just want to mention it in terms of federal legislation, since I've told members of the Hill and their staffs this, but to say it publicly, I too support changes to the Trust Indenture Act, which is, I think, important as an act that we oversee at the SEC to help facilitate the smooth transition. And as I had said earlier in review of the annual report, I think that this could run smoothly, and I think it has every sign to run smoothly if there's a transition to rates like SOFR. I think we will leave our successors with a problem if we go to rates that are frail and rely on commercial paper and CD like BSBY. And so I lack any ambiguity here. I do not think BSBY is compliant with the principles laid out in 2013 and the IOSCO principles for a good, stable, reliable benchmark.
Thank you. Any further comments or questions?
Yes, Madam Secretary, just one thing I wanted to make sure to mention about consumer loans. On December 7th, the Bureau finalized a rule facilitating the transition away from LIBOR for consumer financial products. And our rule establishes requirements for how creditors should select replacement indices for existing LIBOR-linked consumer loans after April of this coming year. And no new financial contracts under the rule may reference LIBOR as the relevant index after the end of this year. So starting in June of 2023, LIBOR won't be able to be used for any existing financial contracts in consumer loans, which total about 1.4 trillion tied to LIBOR. In most circumstances, lenders can replace the LIBOR index with new indices based on SOFR or the prime rate. We totally agree that this is a good move and it will be less vulnerable to the type of abuse we saw in the LIBOR scandal. And we really appreciate all the work by all the FSOC member agencies on this front.
Thank you. Okay, our last agenda item is to vote on the minutes of the council's last meeting. Is there a motion to approve the resolution approving the minutes of the November 15th, 2021 council meeting?
So moved.
Second?
Second.
All in favor?
Aye.
Any opposed? Any abstentions? Okay, the resolution is approved. And before we adjourn, does anyone have other business to raise? Okay, then can I have a motion in a second to adjourn the meeting?
So moved.
And second?
Second.
And happy holidays.
And happy holidays, everyone. Agreed. Thank you. The meeting is adjourned. Happy holidays.
Thanks. Happy holidays, everyone.